Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, lifetime income annuities, part 3 in our series on guaranteed lifetime income in retirement. Welcome to our third segment. We're talking about guaranteed lifetime income in retirement, and now we're going to talk about lifetime income with annuities. And when you think about annuities today, they have really come a long way. I mean, they have never been on the radar of most registered reps or registered investment advisors. But now everybody's looking at the longevity movement, the mortality revolution. Everybody sees the impact of what this is going to do to retirement, and everybody's now looking at it for the first time. Now, people say, Steve, why do you have a non-smoker slide up here? Because I'm trying to show you why the mechanics of a longer lifetime are going to exist and how actuarial science kind of gives us indications along the way. When I came into the business, there was only smoker or non-smoker. But check it out. Even in the non-smoking arena, without an impairment or without a table rating, you're looking at 5 different areas or underwriting classifications. These underwriting classifications, from standard to super preferred, could be 20 to 25% in premium. So if people are super preferred, they have great health, they feel like their longevity is going to be out very much farther, so their premium is now reduced. So when I look at underwriting and I see the expansion from going from smoker to non-smoker and then non-smoker breaking it up 5 different categories, it tells me that they're actually managing this and they're rewarding people who are in the first and second categories well into their late 80s, early 90s. And again, remember, this has very little to do with any medical impact. We haven't had anything really big. And think about this. We're now parsing tobacco use. We've been doing this now for about a good decade. But now this has even come on the table and have it measured. We used to be able to take, you were a smoker, that was it. There was no other category. And of course, because most tobacco use was cigarettes, people would just look at that and say, I'm going to have a reduced timeline because I really smoked. It's a bad habit and it's a mortality killer. It shortens your timeline. But now we're looking at tobacco use, cigars, pipes, chew, snuff, nicotine patch. All these tobacco use is now repricing because we're learning how to live longer and also defeat addiction. So we're pulling out of some of these. Some of these are just weekend and recreational use of tobacco, like cigars and pipes on a weekend or at a party. Cigarette smoking is even changed. There are carriers now that actually offer a smoker that is smoking today 2 to 3 years to get off their smoke. They'll give them a non-smoking rating for the first 3 years of their policy and give them that opportunity to quit smoking. Unheard of 5 years ago. And also, when you're looking at the actual underwriting categories, you're looking at preferred smoker. I mean, think about that. That should be a conflict in terms. But preferred smoker as well as regular smoker. This tells me that even smokers, people using tobacco, there's now an extension of a timeline. Those prices have come down, which tells me that the longevity movement is even affecting these areas. And again, you're looking at cigar, pipe, chew, snuff, nicotine patch, non-smoker rates by some carriers, preferred and standard plus and standard. Look at all this. This is in, again, cigarette smoking on these last 3, but you're looking at all these possibilities and the repricing of product based on these new underwriting ideas. Tale of 2 brothers. They invested the same. They turned 65 and they decided to buy an annuity as part of their portfolio defense, as part of their beta reduction. They decided to buy an annuity. Each one did for $500,000. They were born on the same day. They bought the same amount of insurance, or I'm sorry, the annuity. They deposited $500,000. They bought the same contract from the same carrier. They started their dates of distribution the same. The only difference was when we delivered the policy, one of the brothers actually received a little bit more money on a monthly basis because his timeline was shorter, because in this case, back in the day, the carrier was giving credits for a shorter timeline because one of these brothers smoked. Of course, now we're rewarding bad behavior. But when you look at this, you're going to look at underwriting again. We have a few carriers out there, but I think they're going to start micromanaging this again because they're looking to ways to do mortality credits. And if you have maybe type 2 diabetes, it's been in your family all your life, this could be a way where maybe your income might be higher with certain carriers because they recognize that your timeline is shorter. I mean, why would you buy a lifetime annuity if nobody in your family has lived past 80? You'd never get your principal back. So underwriting it, this could be happening. Annuity underwriting, as I said, smokers, mortality diseases, and morbidity events. Remember, the person's normal health has been fine, but I've noticed that when elders or seniors have accidents where they might break a hip or something, that accelerates their morbidity events, seem to accelerate their mortality. So when I know that, if I can get a good APS, a good attending physician statement, and I understand what's going on, this could be a play. So I'm always looking at smoker mortality diseases that impact short life, as well as morbidity events for seniors and elders that are buying annuities. I want to look at it. Income annuities are a risk management product that is manufactured and sold by insurance companies. I am not sure that there's any other manufacturer of financial products that can actually do what they do and guarantee a payout for the life of the client. Second, it's a mortality product that protects people from the longevity risk with a guaranteed income stream for life. So if you were the Guinness Book of World Records Jean Clement and you lived to 122 years, 164 days like she did, you would actually get this income all the way out. Think about the internal rate of return. If she was on the 1941 CSO at the time that she became a retired person, and she actually had an annuity, and back in that day, they were paying some pretty big numbers because it was high inflationary numbers. They could have been paying 8, 9%. I'm not talking about the payout rate. I'm talking about the internal rate of return. That internal rate of return, what would those numbers be every single year she lived past her mortality, her expected mortality, and all the way out to 122? You're looking at double-digit returns without any exposure to the market. This is why I'm looking at the new mortality revolution, because I think we're going to be blowing by whatever these numbers are today by a full decade, and it's going to add not just the actual guaranteed income, but it's going to actually make internal rate of return on annuities look even sharper. And then the last one, higher rate of return on those who exceed the mortality average, the very thing I just said. So you're looking at basic timeline issues where you're going to be rewarded. Every year you live past your expected mortality, you're going to be taking an internal rate of return add-on to your total rate of return throughout the life of the distribution of that annuity. I'm looking at single premium immediate annuities. I'm looking at deferred income annuities, and I'm also looking at income riders on certain contracts, maybe variable, maybe indexed. I'm going to be looking at these type of income annuities because they produce, not only do they produce and return principal and whatever interest they're crediting, but they also give back an additional longevity credits. Remember, lifetime income annuities generate guaranteed payments by distributing gains, principal, and longevity credits subsidized by those who die late with the capital of those who die early. Think about it. That's where the rate of return is. And when you want to look at it mechanically, let's say a women's club, they were all together and they decided to contribute about $100 apiece. And they put it into a safety box at the bank and they decided we're going to let it roll and see you in 10 years. And so they put each $100 in, so they've all invested $500 as a group. But 2 of those women died over that 10-year period, but 3 women, hey, they're still kicking. That was 167% return. And remember, no exposure to the market. It was based on mortality credits. Those who died early were subsidizing those who died late. And so when you look at this, this is why mortality credits are the alpha of annuities. We don't have dividends, but we have an ability to generate another part besides principal and interest, and we call those mortality credits or longevity credits. Don't forget to watch our next segment on investment income without mortality credits, part 4 in our series on guaranteed lifetime income in retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.